In 2007, the unemployment rate rose by 50 basis points in the 6 months leading up to the global financial crisis. In 2000, the unemployment rate also rose by 50 basis points in the 6 months leading up to the 2001 recession. Today, over the last 6 months, we've seen the unemployment rate rise by 50 basis points. The most recent unemployment rate number came in at 4.3%, with U.S. unemployment now clearly showing signs of gaining momentum to the upside, something that history shows only happens either right before or during economic recessions in the U.S. And as I'm going to show you in this video, that's exactly the direction that we're heading into, which is going to have absolutely massive consequences for the stock market. This recent unemployment rate number is already creating panic, something that we think can be taken advantage of. The unemployment rate isn't the only economic data point that's pointing to a recession right now. A survey called the ISM PMI came in significantly below expectations this month, showing a rollover in economic activity. This is actually a survey that's done on private sector businesses, measuring economic activity at any given point in time. When it's high, it means the economy is growing very rapidly. When it's low, it means the economy is contracting. Like in all of these instances right here that happen to coincide with economic recessions. Now, when the ISM PMI is at 50, it means the economy is neither growing nor contracting. Today, we have the PMI below 50, so in contraction territory. The last few readings have shown the economy is very much struggling, and show a brief extrapolation of this would quickly take the US economy into recession territory. Now, you can see at the beginning of 2024, the ISM PMI was showing signs of recovering. That was getting many people excited about the US economy recovering and heading into an economic boom. If you've been watching our videos, you'll know that we didn't believe this one bit. And this chart right here was the primary reason for this. This is the yield curve in the United States, and we use it essentially to understand where the economy is heading next. Because when we add US economic indicators on top of this chart that essentially show where the US economy essentially stands, we see that the yield curve actually leads the economy by a year. This is one of the most flawless charts in macro. If you're not paying attention to this, you're missing a big part of the picture, because the yield curve essentially represents how tight the Federal Reserve is. If the yield curve is very elevated or steep, it means the central bank policy is very loose and that the economy is very likely to perform well looking forward. And that's exactly what happens in the year after the yield curve has steepened. You see the US economy going into a massive boom. When the yield curve is inverted, like in these instances right here, it means the Federal Reserve, the central bank, is keeping monetary policy tight, and so that the economy is likely to weaken in the year that follows, which historically is exactly what tends to happen. Today, we know that the yield curve has been inverted for the longest time since 1929, which was the year before the Great Depression, which to us significantly increases the odds that we are heading into an economic downturn, and probably quite a severe one, which would mean that the US economy begins to do something that looks like this, which is again what has happened throughout every recession in history. This is why our largest trade on our website is currently TLT, with an allocation of 4 out of 5. This is an ETF that tracks the prices of US Treasury Bonds. This is what the chart of TLT looks like going back to 2000. And you can see heading into and during economic downturns, you see Treasury Bonds rise. In the last 2 downturns, we saw TLT rise by 40%. This is one of the only assets that can actually rise during these periods of economic trouble, which is why we've had a significant allocation to them. In fact, seeing Treasury bond prices rise, like in these instances here, is a recessionary warning signal. When you see Treasury bond prices rise with the stock market falling, like in 2000 or in 2007, that's called a stocks down, bonds up environment, and it's typical recessionary price action. It suggests that investors are dumping their stocks because they're fearing weakening economic activity, and instead they're rushing into Treasury bonds to protect themselves. In one of our recent videos, we mentioned that the market was not yet showing signs of pricing in a recession because Treasury bonds were going down. But as you can see, that situation has changed dramatically since then, with TLT rising about 10% very rapidly. So despite the fact that the stock market has been in free fall recently, our allocation to several recessionary bets on the website, like Treasury bonds, but also utility stocks, gold mining stocks, shorts on the energy sector, has made the returns of our trades incredibly resilient despite this high volatility. Make sure to subscribe to our service if you want to have access to all of these trades. We guide you through all market movements, showing you opportunities as they arise. And it's often with these types of large volatile moves that you get the greatest opportunities. This is a chart of the VIX. It's the volatility index of the S&P 500, and it has spiked to the highest level since COVID, since 2020. It went from an incredibly low level back in July to now a level only comparable to 2020 and the 2008 financial crisis. An absolutely insane move, showing us investors are in a complete state of panic right now, dumping their stocks on recessionary fears. Now, the question is whether we should be panicking along with all of these investors. There's actually been quite a few volatile spikes like this over the last 20 years. When we add the S&P 500 on top, we see that a lot of these spikes coincided with very large market bottoms. That was the case for 1998, 2002, 2010, 2011, and 2020. So these were all instances where you could have taken advantage of these spikes in volatility to actually ride the stock market for another move up. Now, in 2001, you had a spike like this that only caused a short-term bounce in the market that actually eventually turned around. And 2008 was actually a complete exception because this spike right here occurred towards the end of October of 2008, but the stock market actually continued to move down for another 30% until March of 2009, so another 5 months of violent moves down in the market. So although 2008 is an exception, most of these spikes in volatility were buying opportunities for investors. Now, from a technical standpoint, the S&P 500 has broken below this key price channel that we've been looking at for the last 6 months. We've repeatedly highlighted that if the S&P were to break below this level, that would mark a breakdown and increase the odds of a more substantial correction in stocks, a development that would completely remove our short-term optimism on the S&P 500. Ever since the S&P broke below this level, we've seen a rapid 5% correction on the index, so there is a clear breakdown in technical structures today. That being said, with these very high levels of volatility on the S&P 500 often marking significant bottoms, and the S&P 500 testing some of its key moving averages for the first time since 2023, we are currently looking at this very closely as a potential buying opportunity with our members, at least for a short to medium term rally, something we haven't done since April of 2024. You can follow our entire strategy during this period of volatility at gameoftrades.net by buying yourself a subscription and getting access to all of our trades.